this morning Randal Quarles, the Vice Chair for Supervision at the very first one at the Federal Reserve. It's wonderful to have these important speakers come through and tell us interesting things from the Fed. We had Dan Tarullo come a few times and make news, so hopefully we can make some good news today. It's good for us, but not necessarily for you. So Randy is back at Yale, from where he graduated from the law school in 1984, and that, of course, was the height of his career, the most important thing. It's downhill since then. He was a partner at Davis Polk multiple times, and in between stints through many layers of increasing responsibility at Treasury, finishing off as an undersecretary, and time as an executive director at the IMF. Subsequently was a partner at Carlyle, and then had his own firm, Sinosure, before going back to the Federal Reserve. And now he has a very important job. In addition to his role at the Federal Reserve, he has another full-time job as the head of the Financial Stability Board, which is the most important international coordinating group. It's an arm, a creation of the G20 post-crisis in figuring out how to keep the world safe from financial crisis. So it's not just the United States you have to keep safe now, but the whole world. So what we're going to do today is I have some questions, and unlike pretty much any other Fed governor we've ever had here before, Randy's willing to let me ask follow-ups that he doesn't yet know about, and also to take questions from the audience. I will leave some time at the end for that, but if you feel a burning desire, then you can feel free to raise your hand. I may or may not call on you while we're still going on. We have until 12:30, and Governor Quarles has given us the whole morning, so thank you very much for that. Then he needs to run out because he's needed in New York, so we're going to make sure he catches his train at 1:13. But we'll go. All right, so I have questions. And the first one is those of us, so some of us in this room, I think, are interested Fed observers, just in general, and some of us in this room are very in the weeds people with the kind of work that you do and that your team does. And so I'm going to ask a lot of weedy questions. Not all of them will be weedy questions, but I'm going to start with, there is now a new financial stability report that comes out of Federal Reserve. So historically, central banks around the world have been creating these reports. The Fed did not have one that went out externally until recently. And I wonder if you could talk a little bit about what you're hoping to accomplish with this report, what are the costs and benefits of doing this kind of thing that has not been done before at the Fed?
So I think one of the potential costs, and one of the reasons that we had not done a financial stability report before, is that there is no shortage of financial stability reports in the world. Various central banks produce them. The FSOC in the United States produces one. The Office of Financial Research produces one. So what we're trying to, but we do think that there is scope, particularly given the importance of the United States for global financial stability, and the importance of financial stability as a topic within the United States, for an additional complementary focus. So compared to what the FSOC already does, for example, that's an annual report that, while it does talk about the evolution of financial stability over the course of the preceding year, it really focuses principally on structural challenges and what is being done to meet those structural challenges. So last year's, for example, there was a big focus on cyber issues. With the Fed's financial stability report, we really are trying to focus on the evolution of financial stability over the course of the preceding period. We're going to put that out twice a year as opposed to once a year, focus on how asset valuations have changed, how leverage in households and businesses have changed, how leverage in the financial sector has changed, funding risk in the financial sector, focus on the matrix that we have created to think about financial stability issues inside the Fed, but publicly disclose how it is that we're thinking about that. And so I think that is a complementary focus to what the FSOC is doing, for example. I think it provides that we focus on, does that should that require some response from them? So I think that both, both in providing additional information for markets, providing additional information for the public, being transparent about how we're thinking about things, and doing it in a way that isn't simply duplicative of what others are already doing, I think that's the purpose of the report.
Thank you. Moving to something very topical. In fact, there's something in the news about it almost every day now, which is leveraged loans. So I imagine that there's been some discussion of that almost every day where you sit.
Yes.
So we had Janet Yellen here in the fall, and she talked about them and how she was nervous about them. I know that this has been of increasing interest, Federal Reserve, and at many central banks around the world, that just the amount of leveraged credit that's out there and where it is starting to scare people as though it was some kind of analog to the subprime boom that we saw. Mm-hmm. So I was wondering if you could comment just on how you're thinking now about that risk and what things you think we need to do about it or still need to learn about it before we can do anything.
So I think it is. I think it's an important issue, but it's important to think it through quite carefully, right? Because it's not really. It's not a direct analog to the subprime lending from before the crisis. But it does create issues that are worth thinking about. I mean, first, when you look at just the general growth in business credit, I mean, business credit is very high currently. But it always grows. It hasn't grown to a level that's inconsistent with historical precedent for this point in an expansion, for example. We generally always see that. So the volume is high. It's worth looking at, but it's not unusually high, I guess one would say. Then to amplify financial instability, if that were to happen. For the most part, the banks that are originating these loans are not keeping them on their books. They're selling them into more stable holding structures. Most of them go into CLOs. And the structure of those CLOs is such that the maturity of their liabilities is greater than the maturity of the liabilities that are inside of them, and they're not, therefore, as a consequence, practically runnable. Those are stable structures. So if there were, again, to be a sudden repricing of the assets that are inside of them, the holders of the CLO exposure could lose money, particularly the equity holders or those in the lower tranches of exposure to of the CLOs. But people lose money on their investment decisions. That's part of the system. And you wouldn't expect that to be financially destabilizing, systemically destabilizing, to have financial stability amplification effects. But then the question is, so who holds the exposure to those CLOs? Because if you had runnable institutions that hold the exposure to the CLOs, even if they can't run from the CLO, people could run from them if they thought that their CLO exposure was great enough that it posed a risk to those institutions. So we need to understand where that exposure is. We have looked at it for the U.S. banking system. We're pretty comfortable that while there is some backdoor exposure back into the banking system, they sold it off their books, but they have some backdoor exposure. It's both limited enough and at a higher enough level in the risk structure of the CLOs that doesn't appear to create financial stability concerns. But the CLO exposure is sold globally, and we live in a global financial system. So now we've gotten to the question that I think is the important question, and it took a little while to get there, but I think it was important to take that while because lots of the reporting about this and even the policy discussion, let alone the public discussion about it, doesn't go through any of those steps. It simply says lots of leveraged loan credit, Earth must be getting hit by an asteroid, and you really have to think through what is the question that we have to be focused on from a financial stability risk concern. And I think it's that question. Where is the global exposure? So one of the things that we did at the beginning of the year, almost the first thing that I did as chair of the FSB, we set up a process to gather the data and look at global exposure to these holding structures for leveraged loans around the globe. Is it Japanese banks, as anecdotally we hear? Is it other banks? Is it non-banks? Just where is the exposure held? And then on that basis, the FSB and national authorities can decide, okay, is there something that we should respond to here? And the answer may be no. It may be yes, but it really depends on having all of that data.
Thank you. So another somewhat technical question. I promise we won't just do those, but somewhat technical question, which is an important piece of the toolkit, important tool that you have in keeping our financial stability, is the countercyclical buffer. So the ability to go out to the banks and say, we want you to hold more capital than usual because of where we are in the cycle. The Fed has not used that. And so the question is, under what circumstances do you think, what would you need to see? What would be the type of thing that would make you and your team think, now's the time? What's that mechanism and process?
So we do have a pretty disciplined methodology around considering financial stability risks. We've said, with respect to the countercyclical capital buffer, the CCYB, we've said that we will activate that when we see that financial stability risks are meaningfully above normal. Now, quarterly, we look at financial stability risks around in the United States, and we do that as a board, so it's not just me sitting with folks or some subset of the governors, although there is that too. There's also the board as a whole considers financial stability risks quarterly. And we do that by looking at a set of factors. First, asset valuations, and are there stretched asset valuations? And I think we'd see that both in equities and in commercial real estate currently, that those, that there probably are elevated asset valuations relative to fundamentals and relative to history in those asset classes. We look at the borrowings of businesses and of households. And as we've said, business credit seems to be high. It's high as a percentage of GDP. It's not necessarily high as a percentage of, considering the debt service capacity of businesses, because business earnings are also at their highest level as a percentage of GDP in a very long time. But that is a high absolute amount. On the other hand, household borrowing is very low historically, and so non-financial borrowing tends to even out because of the very low level of household borrowing, again, relative to history. You look at leverage in the financial sector, and that's at world historical lows. That's just at extremely low levels. And you put all of that together, and the extreme resilience of the financial sector compared with kind of basically a wash between business borrowing and household borrowing and elevated asset valuations, and we view those that the overall risk to financial stability is moderate, not meaningfully above normal. So I do think that making the decision to turn on the CCYB requires that we be disciplined about it, requires that we live within our framework. That framework is not the only conceivable framework that one could imagine. The British, for example, have begun taking an interestingly different approach to activation of the CCYB, where they've said they think that its principal value is not turning it up to build resiliency in the good times, if you will, but the ability to turn it down as a business cycle tool, really, even more than a financial stability tool. This may be going a little farther than they've said, but I think it's a not unfair, at least summary of how it is that they've been evolving their practice, at least. So they now are saying that they're trying to reach a state where the CCYB is on all the time and at a pretty high level, and they might turn it up somewhat towards the end, but the principal issue, but they want it on at 1%, 2%, all the time, so that come the bad times, they have something to turn down. Mm-hmm. That's a different way of thinking about it. It's a different way of thinking about it than when the CCYB was created in international discussions. It was created as a financial stability tool as opposed to a business cycle response tool. It's a different way of thinking about it in that you don't turn it on only when vulnerabilities are meaningfully above normal. They're going to have basically a flexible portion of the capital stack on always. I think those are things that we could think about. We just shouldn't rush into them. If we're going to do something like that, we should think about it as a methodical change, and we haven't done that. It's not really on the agenda at the Fed yet. Our current methodology would indicate that we shouldn't turn the CCYB on now.
Thank you. So I want to switch gears and ask you a question that was posed to you by my colleague Bill English in the meeting that we had just before, because it was really quite an interesting discussion, and I selfishly want to continue it. And it has to do with overall the role of the Federal Reserve within the administrative state that we have in the United States. So for folks in the audience who are not up to speed on these things or don't follow them all the time, the Federal Reserve does a variety of things other than monetary policy that fall under your umbrella, and that is importantly regulation and supervision, often spoken in the other order, supervision and regulation. So regulation, we kind of understand what that means. That's a normal thing a lot of federal agencies do all the time, which is Congress passes a law. The law doesn't give us a whole lot of details about how we're going to actually carry out that law. And then the relevant agency has to go and write rules and say, this is how we're going to carry out the statutory responsibilities that we have. And there's a whole process by which those rules get reviewed. Once we have all these things in place, we also then have to go and make sure these rules are followed. And that's supervision. And the supervisor has a fair amount of discretion always. And now there is some debate about whether some of the muscular things that the Federal Reserve does under the guise of supervision are actually things that perhaps we should think of more like regulation and should require further review. And this goes to the heart, as you pointed out, I think very importantly, it goes to the heart of how we think about the Federal Reserve and financial supervision and regulation in the context of an administrative state where voters get to weigh in on some things but not on everything, and the legitimacy of those institutions. So in that context, there was a recent decision by the Government Accountability Office that some important supervisory guidance that was in the context of leveraged loans was in fact a rule and should have gone through the same process that regulatory rules go through. So Bill asked you, what do you think about that? And more broadly, how should we think about the Federal Reserve doing its very important job, particularly in the financial stability area, in that context? So there you go. It's a long starting setup before the question.
So, and a very, I think that's a very deep question. I think it's actually one of the most important questions in the area of supervision and regulation. It may sound a little cosmic, but it has a lot of practical consequences. The leverage lending guidance that you mentioned is one of them. There have been other senators have sent letters to the GAO asking for views as to whether other of our supervisory practices are in fact rules that should be subject to congressional review. And I think that it is incumbent on the Federal Reserve and on financial regulatory agencies generally that have supervisory capacity, and those are mostly the bank regulatory agencies, to develop a very clear view as to really even a theory. Maybe that's your job to develop the theory, and we just need to develop a policy. But we do need to have thought through very carefully what it is that we mean by supervision and what it is that we mean by regulation, and what should be accomplished in which way. As we were discussing before this, bank supervision really escaped, if you will, the post-New Deal settlement with respect to the administrative state that was embodied in the Administrative Procedures Act of the 1940s, whenever it was, mid-1940s. Because bank supervision had pre-existed the New Deal, and it was and it didn't seem to pose some of the threats that other agency action could take. It was, the supervisor, the examiner went in to examine the bank and make sure that the cash was in the vault and that the books footed, and that didn't seem to be the same sort of thing, and it had gone on since the 19th century. But certainly post the financial crisis, and really even leading up into the financial crisis, bank supervision had become significantly more athletic. And post the financial crisis, in part for reasons of speed, in part for that's just how it happened, in part for reasons of flexibility, there were a number of quite consequential things that were accomplished as supervisory acts as opposed to regulatory acts that as a consequence escaped this whole structure that was put in place to essentially legitimize the administrative state, the Administrative Procedures Act, and all the interpretations of it that have evolved in the following 70 years. And so what we're seeing with some of these guidance concerns, I mean, they're following in some ways they're eruptions, right? So they seem targeted to particular substantive issues as opposed to this underlying more systemic issue that I think that we have to think through. So one, we need to think through the particular targeted issues that they are, but I think the fact that there's this underlying unaddressed question accounts for some of the oddities of how this is being done. I mean, asking the GAO, I mean, why wouldn't you ask a court? Why on earth does the GAO get to decide what's I mean, that doesn't make any sense, actually. So, but what is very clear and totally appropriate and indicated by all of this activity that we're seeing is that we do need to grapple with this underlying issue and resolve it in a way that is appropriate for an independent institution and democracy. We have a significant amount of independence at the Federal Reserve. I think history has shown that central banks require that independence, that, again, as a member of the democracy, I want the central bank to have that independence, even when I'm not there. I think that benefits us. But we also, the central bank has to, but there do have to be constraints on that, and I think that this issue is at the heart of that.
And what would a process look like? So I'm curious as to where, this is partially a legal question for which I don't know the answer, and you probably have some sense, but where does that process sit? So is it an entire rethinking that has to go through some kind of legislation? Is there because we have a formal form of governance around this that may be unsatisfying. Where would we change it or think about it? What's the forum for that?
So I think, at least the way I think about it now, I don't think needs to be a change in the legislative framework. The legislative framework pretty clearly describes what is a rule if an agency is going to take certain actions. I think there needs to be a careful thinking through at the Fed and the other bank regulatory agencies of what is it that we do that is rule-like, and how will we run that through a rules process. And there is much that we do in the way of guidance that is not controversial, that is clearly beneficial to the public and to the industry, that shouldn't be issued in the form of a rule. But we need to be much clearer in our own minds and then be much more transparent to the public and describe the methods that we are using for making those determinations as to what's going to be a rule or not. I don't think that we have it right currently, but I do think that I do think that we can get it right, and that's a task that we need to take on. So ultimately, the Federal Reserve can do this internally and come up with, and perhaps even change a little bit where they're drawing the line. That might be appropriate to do. Would this ultimately be decided by a court? So you have senators asking the GAO, and at some point, where does it go after that? So would ultimately there be, if we played out that string and the two sides disagreed, a ruling that could perhaps look like Chevron or something of that sort that would say, here's a 3-part test or a 4-part test. So the Fed might try to kind of say, here's where we think it is, but ultimately your line may not be where other people want the line to be. Is that the end game for this, do you think? Well, it could evolve that way. I would hope that it doesn't, I would hope that it doesn't evolve that way. I would hope that the procedures that we put in place after a rethink are viewed as appropriately comprehensive and draw the right lines.
Okay. Want to move on now to talk about the other thing you have to do in your spare time, which is monetary policy. When the Federal Reserve has just announced that they're going to be undertaking a serious review of how they think about monetary policy and the tools. And we also, as I said, Janet Yellen was here in the fall, and one of the things she talked about was in that context. Maybe we should be rethinking a lot of the things because we don't have a whole lot of room to operate anymore since we have interest rates in a very low interest rate environment. I'm wondering what are your thoughts? What do you hope comes out of that process at the Fed? I'd like to see it go.
So this is going to sound terribly anodyne and bureaucratic, but so I don't begin with with a view as to what conclusion we ought to reach, including the view that we ought to change anything. Right? I don't come with a prior that something is broken and this process will tell us how to fix it, nor that everything is fine and that nothing will come out of this process. I do think that it is these sorts of reviews are good for the soul, and there are a number of other central banks that simply have a practice of periodically every 5 years is a not for the central banks that do this, a not uncommon period, to just stand back and say, is our framework in which we're making these monetary policy decisions working? Is it useful? Can it be improved? I think that's a good thing to do, and that's what I view this process as. There is the issue that interest rates have been low, inflation has been low. On the other hand, inflation is difficult to measure precisely. I don't share the concern that some have that, if we're at 1.8% inflation for a significant period of time, that this is a problem that necessarily needs to be fixed. I mean, from my point of view, 1.8 is 2. We've set 2 as the target, and we just don't measure inflation precisely enough to know that we aren't in fact hitting our target if we show 1.8. And so I would not undergo heroic efforts, including rethinking our monetary policy framework or significant monetary policy stimulus in order to edge 1.8 up to 2. I just don't think that level of heroism is necessary. Now, if we were at 1 forever, then you have a different issue.
So turning back then to financial stability, we gave you just a little break there to think about monetary policy. But now we're going to go back to your full-time, one of your full-time jobs. So we had a whole bunch of complex products emerge prior to the last financial crisis, and we didn't really monitor them. We didn't know. We didn't have a mechanism to monitor them. We didn't know how dangerous they were. So now, if this were to happen again, if there were to be Jeremy Stein, who was at the Fed for years, Harvard professor, wrote an essay about how windmill bonds, it was a joke. He said, we're going to get clean energy, and all of a sudden everyone's going to see all these windmills and realize it's a wonderful thing to securitize, and before we know it, we end up. And he's trying to tell the story of how we don't really have a way to monitor that. That could happen and it would sneak up on us. So what have you put in place, or do you think we can put in place? What's the mechanisms that we can have that will protect us from getting snuck up upon again?
Well, there are a few mechanisms. They depend on, they do depend on human diligence, but I don't think we'll be able to escape that, at least in the near future. The FSOC is such a mechanism, and it is, an active point of discussion. So to the extent that products like that develop, the agencies that are closest to those products will bring them to the FSOC. We do have discussions about that. In some ways, I think that what some of you may be familiar with, the FSOC's moving to an activities-based as opposed to an institution-based designation policy actually facilitates focusing on products, new products that might be, that might create financial stability issues. At the Federal Reserve, we do have this quarterly exercise where we methodically think through financial stability concerns. And in that context, we consider new products and how large a portion of the financial sector they are, whether they're creating funding risk or asset valuation risk. And at the Financial Stability Board on the international level, we are, at the moment, the Financial Stability Board, perhaps somewhat anomalously, has not actually had a methodology for considering forward-looking financial stability risk. Basically, it was a full-time job for the last decade for the Financial Stability Board, and quite fairly so, to address the financial stability vulnerabilities that had been revealed by the prior crisis. So it didn't have a forward-looking mechanism. But we are in the process now. John Williams, the president of the New York Fed, has been given the task to head up a group that is developing a forward-looking financial stability risk methodology that should consider, among other things, questions such as new products. And how do you look at a new product and determine whether it is a macro risk, which is not really a Financial Stability Board concern, or a financial stability risk, in which case it would be, and how to calibrate a response. So I think those are the areas in which all of those mechanisms, all of those bodies exist. The FSB is developing a mechanism to consider that, and I think developing that mechanism the right way, but none of that will eliminate the need for human diligence going forward.
Thank you. I'm going to ask one follow-up based on what you just said, and then open it up to the group for some questions. And that follow-up is you mentioned the work of the Financial Stability Oversight Council, the FSOC in the United States, with regards to designation. Mm-hmm. So maybe not everyone in the room knows what this is, but the FSOC was created by the Dodd-Frank Act, and it was intentionally created for this purpose: look across, find the holes, identify things. And perhaps the most important and muscular power that it was given was to designate, originally thought of as institutions, as being systemically important, and then subject to an additional layer of oversight from the Federal Reserve. So the early examples of this were AIG. There was no really muscular federal oversight of AIG prior to the crisis. They would newly be designated, and GE would newly be designated. So there were some other designated. So what has happened is, for a variety of reasons, under multiple administrations, so it's not just one side or the other, we've undesignated these things. Mm-hmm. So we no longer have any non-bank institutions designated as systemically important. And the FSOC has moved towards an intellectual approach of looking at activities rather than institutions, which strikes me as ideally first best correct. What I worry about sitting as an outsider is, how are we going to do activities? So when we do institutions, there's a clear, someone worries about it, they see the institution, they push for it, the institution can push back. Activities, who's taking the political hit to designate an act? I have lots of activities I want to designate. I could go and say them, but who's going to actually do the lifting to try to get that designated? I fear that this is one of those ideas that sounds great, and so we're able to get some people who really like it intellectually to support it, but the cynical side of me sees we're just not going to designate anything. So I wonder, practically speaking, what's the process whereby you would hope, in the best possible world, an activity would come up through the ranks and get designated? How would that work?
So that would work. I mean, the process is reasonably easy to describe, but you're absolutely right to say it will very much depend on the buy-in of the people who are sitting on the FSOC at any particular time. But if any of the regulatory agencies that sits on the FSOC, or more likely for something that was potentially systemic in consequence, a material subset of the agencies that were sitting on the FSOC saw an activity developing that they thought was potentially financially systemically significant, but also that they couldn't address in isolation, and obviously, particularly in the United States, that's very likely to be the case. It's not just banks that engage with certain products. There will be non-banks that are regulated by other institutions and different types of banks, and there may be insurance companies, and all of that needs to be brought together into one place. And so if an activity like that is identified, it's brought to the FSOC. The FSOC discusses and considers it. The staff develops analyses, and the staff of the various participating agencies will develop analyses. And will determine whether that activity appears to be systemically important for the financial sector. Now, in the framework that the FSOC has identified, then rather than designating institutions, which really wouldn't be the right way to address kind of a cross-cutting activity like this, the first step would be to coordinate the regulatory response among the various regulatory agencies that have first-line responsibility for that activity in their different jurisdictions, to have a coordinated regulatory response to address the potential systemic consequences of that activity. I mean, you could imagine certain types, a product that you think is growing too fast, or that is increasing leverage in non-transparent or excessive ways within the system. After an FSOC discussion, you'd say, okay, bank regulators, insurance regulators, go back and address this. So I think I think that's fairly straightforward to do. You designate the activity. You wouldn't designate an institution, and when institutions are designated, the Fed is given responsibility for supervising them. But instead, you designate the activity, and you'd coordinate the response of a variety of regulatory agencies with respect to that activity. All that's very doable. I think it's very workable. It will depend on the willingness of the people on the FSOC at any particular time to do it.
Thank you. Questions from the group? Yes.
Thank you, Governor, for your time. My name is Sanjar, first-year MBA student. So you told about the importance of Federal Reserve independence, and there in the world, like many other not independent central banks, as in Russia or any other post-Soviet Union country. So how can you tell about the problems that they have that Federal Reserve doesn't have?
Well, I think the independence of central banking. I think history shows us that is very important for the outcome of monetary and financial policy. Obviously, the paradigmatic example is hyperinflation in Germany before the war. There are other examples from around the world where if you have sort of political control of monetary policy or financial decisions, that's not in the best interest of the country. And so the Federal Reserve was among the first central banks. The Bundesbank may have been the first, but the Federal Reserve was among the earliest central banks to essentially enter into an agreement with the Treasury that its decisions would be independent, and that was done in 1951. Since then, most other advanced financial economies do have given their central banks independence because of the expected improvement in outcomes. And again, I view that as entirely consistent with democratic accountability, because we, as citizens of a democracy, can look and say, this is an outcome that in order to get the outcome that we want, which is stable monetary policy, we should create some insulation between the monetary policy decisions and our current political impulses. That's a very sensible thing a sensible democratic decision for people to make, and it's been made in the United States. And I think it's been very helpful for us. We have had, long periods of quite good monetary policy outcomes in the U.S.
Thank you. Yes, sir. You had your hand up a moment before. Yes.
Managing the economy, the Fed has wanted help from the legislature and you guys don't feel you really had it the way you should have had it. And so what would you ask of these people to do differently and better that would be of a help in doing the overall job?
So currently, I would say I'm trying to think, the legislative framework in which we operate, both for monetary policy decisions and for financial regulatory decisions, I think I think gives us all the authority and powers that we need. I do think that for example, some things recently that have been done that I do believe were helpful. Even before the legislation from last year that that directed the bank regulatory agencies to tailor regulations, we were in the process of doing that. That is to say, adjusting the stringency of regulation to the systemic importance of banks, and the most stringent regulation would apply to the most systemically important banks and lower it for community banks and so forth. We were in the process of doing that. I think the passage of that act provided kind of clear political support for that, political direction for it. Perhaps made it. It was something that I think was non-politically done, and it was being conducted in a very analytical way, and we have continued to do it in a very analytical way. But I think that the passage of that act was important political support for that. So those sorts of things I think are useful. But the general legislative framework is perfectly satisfactory currently, I think.
Thank you. Is there a question here? Professor English.
So I wanted to go to something on monetary policy and kind of financial stability together, which is the Fed's balance sheet. So the Fed's in the middle of a process of normalizing the balance sheet. The FOMC has more or less decided on the size that they want, and you'll be there in September, but not the composition. So I wanted your thoughts on what's the ultimate MBS share here. I guess the committee said they want to primarily hold treasuries, but that might leave still some MBS. And also, what's the right maturity mix? There may be financial stability implications and also monetary policy implications down the road of different maturity holdings of treasuries. So just your thoughts on that.
So most of those decisions are on the table, and we haven't decided them. That whatever it is we ought to do sort of very gradually and in a way that's clearly explained in advance, and not take actions in order to accelerate reaching a particular desired end state of the balance sheet that could be disruptive to markets. So all of these decisions will play out over a long period of time, even when we have a general end state in mind. I think there are, with respect to the maturity composition of the balance sheet, there are arguments on both sides of that question. I can see the arguments on both sides of that question. And principally the issue there is whether we would purchase essentially proportional to the Treasury's issuance of Treasury securities, or whether we would focus more on the short end, which would give us some more ability in a future downturn where we were at the zero lower bound, to perhaps provide some additional accommodation by an operation twist, by a maturity extension program if we were on the short end, without further increasing the size of the balance sheet. If for example, we felt that there were political constraints on another exercise of QE, actually increasing the size of the balance sheet. There's a lot of, there are differing views as to the effectiveness of maturity extension programs, and the maturity extension program that we underwent. I'm not sure that I would engage in heroic actions in order to create the space for one if it really did require heroic actions, and we thought that it might be disruptive. On the other hand, if the costs of creating that space were relatively low, then why not? So those are the issues that we're thinking about. It may also be if I were sitting at the, no, actually I probably shouldn't comment on that. I feel like Hagrid in Harry Potter. I shouldn't have said that. I was about to say.
Should not have said that.
Exactly. I was about to say if I were sitting at the Treasury. I thought, oh my gosh, I shouldn't say that. So I won't.
We have time for one more question. Let's see. Where haven't I gotten? I'll go to the middle. Right.
Yes, thank you for your time. My name is Grant. I'm actually a physicist here at Yale. So as globalization continues, I would assume that our economy, and especially the stability, becomes more intertwined with our major trading partners, particularly the EU, among other places. But if I had to judge from actual policy, I'd say that over the past few years, the continued divergence of the policy, we've seen interest rates struggling to get off the ground in other places, implies that the U.S. economy might be more insulated than we previously thought. Does that imply anything for stability? Do we need to worry as much now as we might have thought before the crisis? Is the U.S. economy actually more insulated now, as I would have to judge on the basis of policy differences? Or?
So actually, I think that the U.S. continues to be more integrated into the global economy than it was, say, even at the beginning of my career, which is a long time. I guess that's a long time now. But I think what we're seeing there with those differential results are really not the result of less integration, but simply different policy decisions that have been taken. The policy response in the United States was different than the policy response in Europe, particularly with respect to the strength of the financial sector, and that has helped support a stronger economy, but not a less integrated economy. I think we continue to see feedback into U.S. economic activities. We consider the U.S. economic outlook in making our monetary policy decisions. The effect of international developments are a very important part of that, and more important than they were, even in the 90s, really, and certainly more important than they were 40 years ago. So we both are very integrated and are continuing to become more integrated with the rest of the world.
Governor Quarles, thank you very much.